Hello there. So yesterday somebody asked when EPR Properties will be resuming their dividends. In this video I'll be covering that. I'll also be covering an update on the company. It's released a new investor presentation, so I'll be going through the updated parts of that as well in this video. Then I'll be going through the balance sheet and the cash flow, and then I'll be looking at the forecasts, and then I'll be giving you my forecast and my opinion on whether I'm buying, holding or selling the company. If you're new to this channel, welcome. My name's Andy, and on this channel I like to talk about money and success. If you're interested in making, saving or investing money, please be sure to hit that subscribe button down below, hit the notification bell, and then you get notified every time I release a new video. And if you enjoy this video, please do remember to give it a thumbs up, because that helps the YouTube algorithm, which in turn helps me, and I of course do appreciate that. Have you clicked that yet? Fantastic, let's move on. Now, before I start, I do need to give you the whole disclaimer thing. I'm not a financial advisor. This is not financial advice. I will be telling you whether I'm buying, selling or holding these shares, and I will of course be giving you my opinion as well as giving the results of my own research. But before you invest in any stocks or shares, you do need to be responsible for yourself and do your own research and due diligence. There we go, that's that done. First, I'm going to go through the updated part of the presentation, which is the latest investor presentation. I've just pulled out the selected updated pages. Some of it is the same as a previous presentation, which if you're interested in seeing, I went through in detail in a previous video. I'll put a link above and I'll put a link in the description down below. That's the one where it said EPR stops dividends. I think I called that one. So if you're interested in that, click and see that video, maybe watch it after this, and that will also give you more detail about what EPR actually do. I'll give you a quick overview now. EPR is basically a REIT. It's a specialist REIT. It has things like theatres, cinemas, golf courses, that kind of thing, indoor entertainment. It's a specialist REIT. If you're not sure what a REIT is, a REIT stands for Real Estate Investment Trust. I've also made a video explaining what a REIT is. I'll put a card for that up above now as well, and I'll put a link in the description down below. So if you're not sure on either of those two things, have a look at that and you'll be able to see those at your leisure as well. But now let's have a look at the updated stuff. That's what we're going to do now. So this is the latest investor presentation, September 2020 for EPR Properties. There's some pictures there showing what EPR Properties do. As you see, they've got theme parks, ski resorts, water resorts and casinos. This is just their COVID impact statement. Basically, the key thing to note on here is that they've borrowed an extra 750 million on their revolving credit facility and that no debts mature until 2022. That's an important thing. They've also suspended cash dividends to common shareholders and they've suspended the share repurchase program. That helps them to retain cash in the company, and that's prudent, of course. It's also worth noting on here that at the bottom there it says portfolio reopen. Approximately 81% of the company's properties are now open. This is as of September the 11th, 2020. So 81% of things are now open, which implies the worst is behind us now and things should start to improve. Portfolio reopening. So reopening began mid to late August. At that point, 71% of EPR's theatres were open. Planned timing is state by state and city by city. Operators are diligently developing health and safety measures, which hopefully will enable them to all be fully open. And that's great. If you remember in my previous video, one of the things that AMC, which is one of the biggest clients for EPR Properties, had said is that they could survive being shut down until Thanksgiving. Obviously, they're now mostly reopened, so that hasn't happened. So that's good news in that respect. 92% of non-theatre properties are now open. So this is again as of September the 11th, 2020. So that's good news as well. Collections for July and August have collected 30% and 35% of contractual cash revenue respectively. Now that's pretty low, so that I wouldn't necessarily say is a good thing. I'd say that's a bad thing, but at least they've collected something. But that'll explain when we get to the cash part later and you look at the cash flow and the income, that will explain a lot. Permanent rent adjustments. So they've actually adjusted rents approximately 5 to 7% on an annualised pre-COVID basis. They're working closely with customers to structure agreements to ensure long-term health and protect the position as a landlord, and they've addressed 90% of annualised pre-COVID contractual cash, rent and interest payments. Agreement structures to ramp up through 2020 and beyond, vast majority provide repayment of all deferred rent. Now that's an important thing. So they are planning on getting the deferred rent back. So whilst there's going to be a dip this year, future years will be bigger as a result of the catch-up payments. But obviously that's only going to happen after things start reopening And those clients of EPR Properties, the tenants if you like, are able to pay them back, because the last thing EPR Properties want to do is put undue pressure on its tenants and essentially force them out of business, because that would then mean EPR would need to repurpose the buildings, which I spoke about in the previous video if you remember. Where rent concessions were provided, we received greater or equal value through additional lease term, additional collateral or other benefits. So again, that's good news. They've restructured the AMC lease agreements, which if you remember, AMC is the biggest client for EPR Properties, making up 18% of their income. Reduces risk, improves collateral and enhances the position in the event of a reorganisation in exchange for rent reduction and deferrals. Now that's the bit that worries me a little bit, rent reduction. So they've done some kind of a rent reduction there, which will increase the income for EPR Properties. That is not a good thing. But then if you look, the key features, they've entered into a master lease for 46 of their 53 AMC theatres. They've extended the average lease term by 9 years to 15.5 years. That's a good thing. And they've got a rent escalator of 7.5% every 5 years. So they're attempting to claw it back that way. So actually, what I think they've done is very prudent, because once this whole situation is behind us and lockdowns are opened up and the world gets more back to normal, if you will, then the rents can start to increase. And if you remember, every time in history, always look back to history if you want to predict the future. It's not a bad indicator. Where there's been recessions of any type, be that by a Spanish flu or an economic disaster or even a war, doesn't matter. Any of the reasons, whenever there's a recession, there's always a boom after the recession. So it makes great sense for them to plan like this, because they can then increase things in those good times that will inevitably come after the dip. So that I would say is a good thing, and they're planning accordingly and being sensible. So master lease dividend into 4 tranches with staggered initial terms, 7 transitional property leases, opportunity to reduce exposure to AMC through termination and releasing or selling, because they don't want to have one great big client. AMC at the moment makes up 18% of all of the income for EPR, and that's too big an amount. And EPR, if you watch my previous videos, I did point this out in there, they're wanting to reduce that so that they grow. And EPR are a rapidly growing, very aggressive REIT actually, which is one of the things I like about them. I made a video when I first invested in them, which is another video. I'll put a link up above where I cover that in much more detail, as well as what they do. So you can watch that video for that. I'll put the card up above. I'll put the link down below. You can watch that. That's a different video entirely. But anyway, that's good news. It's a point. Rent reduction deferrals, reduced total annual fixed cash rent by approximately 21% or 26 million to 96 million. Master lease deferred rent repaid in equal monthly instalments over first 14 years of lease term, and a transitional lease deferred rent repaid over the term of each lease. So they're reducing the rents, but then they're trying to claw it back, is basically as I see that. Which makes sense, because you don't want AMC to go out of business while they're such a big client. That would be like, your core tenants going pop, and then you've got to repurpose a whole host of theatres, which would be a nightmare. Doable, but not good. So deferral information, that information is on this screen now. I'm going to leave this here. You can pause this, go back and review this at your leisure. The key thing is we've only got 1% extra vacancy there, and it shows you the amounts being deferred, but bear in mind deferred isn't completely written off. That will be got back at a later date. Statistics for the 142 million of projected total deferrals and the status of all agreements based on annualized pre-COVID contractual revenues. Average deferral period is 11 months, average months deferred 5 months, average collection period 32 months. So as you can see here, they're expecting to collect it all within 32 months. That's the basic gist of it. So the rent that has been deferred should be collected within 32 months, which is just under 3 years' time, isn't it? And if you remember in my previous video, I had a guess at that, what that was going to look like. I was actually pretty close, in fairness. In fact, this is within the range that I predicted if you watched that previous video. So I'm quite chuffed with that outcome. So that's good. That's what I was expecting anyway. So financial performance, total revenue. Now you can see here the changes. It's 34% down on total revenue, 214% on net income, actually making a loss. I'm going to cover that in more detail later. Free cash flow for operations, was a profit, which is good for a REIT. We need that. Although still 70% down, which is massive. Net income per share was a loss, which obviously explains why it couldn't be paying a dividend. Free cash flow per share, however, was a positive, but only a slight positive, and ordinarily it would pay a bigger dividend than that positive, which is why the dividends needed to be suspended, which just goes to prove that the management did do the right and responsible thing. So that's good. Expected revenue recognition and collections. So in the last 2 quarters of 2020, they expect to collect 65 to 75% of their pre-COVID contractual cash revenue to be recognised, and by the end of the full year they're expecting that to be 70 to 80% of the cash revenue to be collected. They're expecting it to be 50 to 60% or 55 to 65% for the whole year. But bear in mind, then they've got that catch-up thing in place, so over the 32 months following they should be catching everything up. That's the plans they've agreed with their tenants. But at the end of this year, they will be down. So when we look, if I do another video later on, which is very likely, showing the state of play at the end of the year, I might do that at the end of this year, I might do it at the beginning of next year when we're reviewing the final quarter, then you might look at that and go, yeah, it was down, but we're expecting it to be down. That's what they're telling us here. They're giving us the advance notice of that. Now, so to answer the question of when the dividends will be resumed. So according to the Dividend channel, they are predicting that the next dividend will be September the 28th, or that's when it will go ex-dividend. It would actually then be paid after that, and they're expecting it to be 14.24% yield. Now bear in mind, this is just one website's prediction, okay? This has not come from EPR itself. EPR have not stated when they will be reinstating their dividends. Their latest investor presentation and notes all say that the dividends is suspended, and they have given no indication at all of when the dividends will be reinstated. I need to make that really clear. So what we're looking at here is just literally the Dividend channel's view on that. That is it, okay? Now I have another view on that as well, which is from Dividend Max. Dividend Max are forecasting that they will go ex-dividend on Thursday the 28th of Jan 2021 to actually pay on Tuesday the 16th of February 2021, and they haven't stated what the actual yield will be, which, you know what, I think that is fine, because they don't know is the truth of the matter. And I think that this is a much more realistic prediction. This is closer to what I'm expecting. I'm expecting it to be January, maybe as late as April or May 2021 when they resume their dividends again. And we don't know if they'll resume them back onto a monthly basis like they have been, or if they'll go on to quarterly. They may well go quarterly. If you look at these two predictions, the Dividend channel seem to think they'll go monthly again, whereas Dividend Max are predicting that they'll start paying quarterly again. And there's a good argument for them paying quarterly, because it helps them to manage the cash flow and just see how things are going. So I wouldn't be surprised at all if they come back quarterly and then switch to monthly, maybe even after all that deferred rent is caught up, just to make sure that it gets caught up so they know exactly where they're at. So it might be that we're looking, 32 months down the line before they go and start going monthly again, or they may just go monthly straight away, which is what the Dividend channel are expecting. Nobody actually knows is the truth of that. So all I can do is report on what the forecasts are. My feeling is it'll be early to mid 2021 when they resume their dividends, and well, you'll see in my forecast in a little bit what level I think they're going to be at, because I'm going to show you my forecast, so you'll see that in a minute. So let's now quickly look at the cash flow. So the cash flow, the key thing here I want you to look at just simply is the net income. I've just pulled that one metric out here, and we're looking at this quarterly. So in their worst 3 months, they made a loss of $63 million up to June, basically, and that was the worst month. Everything was closed, if you remember, so that is the worst 3 months. We haven't got the next quarter's results out yet, so we can't review them yet. When they come out, I probably will. So I need you to remember that figure, minus 63 million, and bear in mind that's over a quarter, so that is 21 million per month loss. So it's a loss of 21 million per month. Now let's look at the balance sheet. Now on the balance sheet here, the key figure I want to look at here is the cash and cash equivalents, which is basically 1.007 billion. So it's just over $1 billion. So that 1.007 billion, if you took that and divided that by 21 million, which is the amount they were losing each month in their worst 4 months, they actually have enough, just cash, forget other assets, forget selling assets, just cash, they have enough cash and cash equivalents to last for 47 months, which is actually much better state than they were in their previous prediction. Now, it's interesting that the analysts have downgraded forecast. You'll see that in a moment. We'll come to forecast shortly from analysts. And the share price has gone down since me making the previous video, which actually means it offers better value now, because you've got a slightly more robust company that can now last for longer, if you like, in its worst time. But its worst time is now behind it, which is obviously a good thing. So from here on in, income will start to increase for EPR Properties. And we know that even if it was as bad as it was then, it's now got 47 months worth of just cash in the tank, if you like. Forget selling other assets off, which I'm going to look at in a moment, other assets, by the way. But just from cash and cash equivalents, if it keeps its dividend suspended, it can actually survive 47 months. Whereas previously, if you watch my previous video, it was a 43-month prediction. So they've actually managed to extend that, which is good news. I would say things are actually panning out a little better than expected, which is good. So let's look at the assets to liabilities now. So the total asset is basically just over 7 billion, and the total liabilities is just over 4 billion, giving a ratio of 1.64. Now, if you don't know, anything over 1 is deemed good. So 1.64, that's a good ratio. I'm very happy with that. It is a good liquid company. That's not ringing me any alarm bells. Now, that makes a net value, if I take the assets away from the liabilities, of $2.7 billion. And yet, if we was to look at the actual valuation of the company, it's got a market cap based on its current share price of $2.2 billion, which means it's actually selling a discount of over $500 million. So at the moment, as a value investor, which is what I am, this is offering very good value, because the assets are actually worth more, even after deducting the liabilities, than the share price. So when you're buying the share price, you're able to buy the assets at a discount. That's a good thing as a value investor, which obviously is what I am. Now let's look at the forecast, speaking of the share price. So the analyst forecast is that in 12 months' time, it will be worth $33.20 per share. Bear in mind, it's currently $29.75 per share. So they're predicting an 11.6% upside in 12 months. The high forecast is for it to be $41 in 12 months' time, and the low is for it to be $25. You've got 2 analysts predicting high, 2 on hold, and 1 on sell. Personally, I wouldn't be surprised at all if it is $40-ish in a year's time. It may well be 33, it may be 35. But I think once the things start getting repaid, especially if it resumes its dividend, we can expect the share price to increase. So that's my view, of course. Now, my forecast here, I'm going to show you my 3-year forecast first. So my 3-year forecast is that the current price at $29.75. I've got 2 outcomes I'm going to go through with you. It's actually 4 outcomes. I'm going to do you 2 3-year outcomes and 2 5-year outcomes. So this is my more optimistic outcome, and then I'm going to show you a more pessimistic outcome, so you can see what the return on investment would be either way over 3 or 5 years, depending on how quickly it recovers. Now, bear in mind, those deferred rents get paid back in 32 months. So in 3 years' time, the rents should be caught up. So provided they are, going back to these share prices is very, very likely. If you watch my previous video, I analysed the share price and showed you that in that. So if you are interested in that, I recommend you look at that, because I go through the norms in that video. I'll put that card up above for you. So if it gets to $72 per share, which is a very realistic price for this share, by sometime in 2023, and you'd bought, say, $10,000 worth, that would mean you'd have a capital appreciation of 142% capital gain, because you'd have your shares would now be worth $24,201.68. And dividends, assuming the dividends are cut by 50%, so they're only paying $2.30 per share, which is realistic, by the way. Don't expect the dividends to come back full. I'd be surprised if they do. After this, I think the dividends will come back reduced, and they will increase them, and I think they'll increase them quite quickly once they know that things are stable again. but they won't increase them back to full, I wouldn't have thought, until I've got all that deferred rent back, which we know is in 32 months' time. So expect a lower initial dividend to come in, and 50% I think is fair. Half in the dividend is a common thing for companies to do. Now, assuming it halves the dividend and it goes to $72 per share, you're looking at 142% capital gain, 15.46 total earning on the income side on the dividends, and that makes an average of 52.49% per year, which is obviously fantastic. So that's one outcome. That's my most positive outcome. It's downhill from here. Let's have a look, folks. So if it takes 5 years for it to get $72 per share, you've still got obviously the same gain, 142%, but it's taken longer. It's taken 5 years to get there. With the dividends, you're getting more dividends because it's now over 5 years instead of over 3 years. So you've got 38.65% of your investment back in dividend income. So your average annual return there is 36.13% per year, which is great. I mean, quite frankly, that's a great return. So that's assuming a 50% cut and assuming it goes up to $72 per share, which is very, very plausible. I think this is a likely outcome. Certainly by 2025, it may even pass it, if I'm honest with you, in my opinion. And if you hold it longer term, it almost certainly will. You know, in 20 years' time, we'll look back at this and it'll be like, you could buy it for that price? It'll be a bargain. But that's what my forecast is. So my lower forecast is for it to go in up to $50 per share by 2023. Bearing in mind that there was an analyst forecasting it to go to $41 per share just in the next 12 months. So I'm giving it 3 years to go up only another $9 per share. That would give you a 68% gain on capital, plus you would have 7.73% total earned. Now, why is that less total dividend? Because I've also cut the dividend further. I've assumed a 75% dividend cut, which is plausible. So if they're only paying $1.15 per share, because they might come back at that. If they're being prudent, they might really hammer that dividend down, and that would be hammering it down, knocking it back 75% per share would be hammering it down, in my opinion. And that would mean $1.15 per share, which is 75% cut off the original dividend. So you only get 25% of what the dividend was before this crisis. Now that will increase, of course, but I'm assuming it goes down and stays down for the purposes of this example for 3 years, and then the next one we're going to cover, it will be 5 years. So if it goes down and stays down for 3 years, over that 3 years, you make an average return of 25.26%, which is a stonking return on investment over 3 years. And if it goes like that over 5 years, you make a 17.47% return over the 5 years. This is annually, so 17.47% per year return. So 68% capital gain and a 19.3% in dividends and in income. So really, that's my outlook for this company. That lets you know where I think it's going, really. Those are the possible scenarios I see happening. I still think they're very probable scenarios, very likely to happen. I still like the company, I'll be quite honest with you. I think the current share price, $29, under $30, I think the share's a bargain, quite frankly. I do believe in it. If you want to, like I say, if you're not sure what the company does, I urge you to look at what the company actually does. And if you think those kind of things are going to cease to be, then do not buy this share. But personally, I think the kind of venues that this company invests in, they're going to get more and more abundant over the years, certainly over the next 10, 20 years. And I'm a long-term value investor. And right now, I see this as good value. I probably will be buying more shares. I hold quite a lot of shares in EPR Properties already, but at the current prices, I'm going to probably buy myself a few more to cost average down. So under 30, I'm very happy. I hope you found this video helpful. If you did, please remember to give it that thumbs up for me. Other than that, thanks for watching. Have a nice day and bye-bye.